So Sunil D'Souza joins us, Managing Director and CEO with Tata Consumer. Sunil, fantastic to have you back with us. Thank you for joining us. Let's start with the big picture. The quarter gone by has been a challenging one for the sector. It's been a challenging one for the FMCG industry, largely because of input and cost pressures. What is your experience been at Tata Consumer? Because we are going through a patch of inflation which we've never seen before.
Before I get to this specific question, just wanted to highlight that Tata Consumer has declared, as a company in existence, we've declared results for 6 quarters and 6 quarters of double-digit growth. So it's been a decent growth for us even this quarter. Net of divestments, top line up 11, bottom line up 5. Efficiently delivered, about 16 days taken off working capital, 1700 basis points improvement in free cash flow to EBITDA. And our strategic priorities, which we had defined well in play, whether it's outlet expansion beyond 1 million outlets, A&P up by 75%, strengthening brands, innovation now ticking up to 2.5%, e-com, new way of shopping for the consumer, 39% growth. Our new legs of the business, Sampann up by close to 30, Soulful in 4 times the outlets. Narishco, which is our ready-to-drink business, is up year to date by 100% plus. And most importantly, market share gains, whether it's in tea about 170 basis points, 168, 170 basis points, and salt up about 400 basis points. Now, coming back to your question, Nikunj, for Tata Consumer per se, we see 2 different facets of inflation. And this is because there is a different picture happening for us in beverages and there is a different picture happening for us in foods. In beverages, we are seeing an easing off of inflation because the primary driver out there was the jump in tea prices, which happened last year, peaked about September of 2020, and after that it has started tapering down, and now it is almost range bound for a couple of months or so, and that's why you would see the uptick in the India beverages margins. And despite the fact that we spent extra behind brand building, we've roughly increased our A&P spends by about 3.5 times versus the same quarter last year. We've still delivered good margins. And we expect that to continue to be improving from here on. On the foods business, on the other side, is a reverse picture, because foods is a very heavy product per se, salt, the primary business being salt. And therefore, freight is an important component. Apart from that, energy is an important component in converting salt itself, and there we use coal, etc. Those prices are jumping up. So there we are seeing inflation coming up, and I think, like you mentioned, it's come up very quickly, very steeply. And going forward, we've got to figure out, and we are in the process of working out various options, various levers at play. There is pack sizes, pricing, A&P, discretionary spends. But yes, in the foods business, we will have to balance top line margin and costs.
So how do you see the dynamics changing now? 50% of your business broadly is, India business is broadly 50%. Then you got 2 big businesses, international, which are about 25% each. How do you see the dynamics changing?
Well, absolutely. Nikunj, if I step back, Tata Consumer was created to fulfill the FMCG ambitions of the group. And we said we will first become a large F&B player and then become a larger FMCG. So we're already a decently strong beverage player, I would say. We're among the top 2 players in tea. We're now starting to make a play in coffee. So beverages, I think we've just got to keep it going. The ready-to-drink business is the other leg that we're building out, and you would see the numbers. But again, the big boss is India packaged beverages, if I may call it. And the foods business is relatively, right now, salt, and I think food is a huge canvas that you can play with. As I've said earlier, we've very, very clearly looked at where we should be going in portfolio terms, looked at 4 distinct platforms and expansion out there. So yeah, international business, I would say it's a steady business, decent profitability. Margins are now up to, bottom line margin is up to 14% now, which is, I would say, a recent historic high. So very steady cash flows, decent positions. India beverages going from strength to strength. But the big jumps that you will see will be in the foods business as we go forward.
But for the tea business, can I safely say that the margin challenge is behind? Because this was one business where the impact of high tea prices had kicked in a couple of quarters ago.
I would say, Nikunj, you should see margins going up from here on for the India beverages business because last year when the tea costs started going up, we were slightly behind the curve on taking pricing up. But over, I would say, a 6-month period, we did normalize. Now, when tea prices are coming down, the margins are still not where I think they should be. Yes, there might be a slight bit of a downward pressure in tea costs. And if that is so, then we'll have to look at pricing. But broadly, I would say pricing being stable, tea cost moderation, I would say margins in India packaged beverages would be improving from here on.
How are you planning to differentiate in the food business? Because that's a business which, in a sense, there is hyper competition, local and national player, global, local and organized players. Be it's a business where the dependence on commodity prices, atta, chawal, dal, is extremely high. How are you planning to differentiate? Because that's one space where you're really scaling up all your brands and all your portfolio.
So Nikunj, when you say the India foods business, I would say, we've got a very solid salt business where if you take put together all the different brands that we have, and we are going to expand the offerings in salt also as we go forward, we're close to 38 share and very decent margins, I would say. I mean, almost top and best in class in the foods business. On the other, I would say we still have long way to go in building decent positions. But as we build those decent positions, I think 2-3 critical pieces that we've got to watch out for. Enter categories with scale and make sure that the products you're entering with have got decent gross margins built in. Because if you've got to build either a category play or if you've got to build share, then you've got to have enough firepower in terms of margins which can afford good branding advertisement spends to grow. So that is where we'll go. And I'll give you an example of where we've executed to that. And this is the inorganic piece, Soulful, right? I mean, we saw an opportunity to enter a space where we were not present. And we went and acquired Soulful. Soulful is very, very healthy gross margins. It's a differentiated play. And therefore, we think we can build strong businesses. But if you enter a commodity, as in without a differentiation, you will not have margins, and therefore, like you said, you'll struggle to play there. So whether it is in even the near commodity plays that we have, like pulses, we only play in unpolished dals. If I were to go for scale, I would go with polished, but if I go with polished, I will have no margins, and that's why we stayed away from that.
Has the international business, Sunil, stabilized, especially the Tetley business?
Well, absolutely. The international business, I would say Q1 took it on the chin this year because last year they had this huge advantage of pantry loading, right? The pantry loading phenomenon was much more in the developed markets than in India. And they went through this high. Q1 was the high, Q2 a bit of tapering off, and Q3 onwards was normalized. So you did see a huge hit on the overall top line of the international business last quarter, that was in Q1. Q2 was relatively flat. While the reported numbers are -6%, overall the international business is +0.4%. And the reason for that is because last year in our base, we've got 2 businesses which we divested. The food service business in the US and the out-of-home coffee business in Australia. So broadly, it's come on to par. And while it's come on to par, the bottom line has improved. Like I said, EBIT margin is up to 14%, which is a recent historic high. So we feel very good about where we are in the international business. And the other thing we feel good about is this year we've brought in all the brands together and started executing what we call the 3-brand strategy. So for example, in the UK, we've got Tetley, we've got Good Earth, and we've got Tea Pigs. And the reason we are going with a high focus behind Good Earth and Tea Pigs is because we need to move our portfolio from just being black tea into a larger tea play. The growth is happening in specialty and premium, and that's where Tea Pigs and Good Earth comes in. And we are seeing tea pigs and Good starting to contribute in top line as well as on the share front.
You know, I have to turn my attention to the market just to show that what's happening in terms of the sell-off, and the selling in some of the mid-cap stocks has just, it's now becoming excruciating. If you bought, let's say, IRCTC 15 days ago or 10 days ago, it's a fall of almost 35-40%. For a 6,000 rupee stock now, IRCTC is now threatening to go below 4,000. That's the reversal what we've seen. IEX, again, a very, very sharp reversal. Tata Power, Tata Consumer has not gone down, but you know, across the board, I guess the selling has only intensified, be it FMCG, with the exception of ICICI Bank. I guess, you know, the entire market is in a state of flux, so to speak. Sunil, a lot of Tata companies are going through a serious policy change in terms of capital allocation. We just got news over the weekend about how Tata Chemicals is looking at selling one of their big acquisitions of soda ash in US. Are you looking at also selling and exiting some of your businesses which the company acquired in the previous cycle?
Nikunj, let me just say, geographic and product portfolio is a screen which you check through from time to time. Right now, where we are is we've got a strong international business. There were pieces of the international business which did not fit in, like the coffee business, out-of-home coffee business in Australia, the food service business in the US. Those we've divested already. And also we've defined the 3 core markets which we are going to play in, which is UK, Canada, US. As I said, right now, decent share positions, decent top line growth from an international perspective. Now, of course, you can't compare the growth compared to India, and steady cash flow generator. I mean, that's the role which international plays. They're playing that. So for now, I mean, we are in the international business. In fact, if anything, we are looking to cost optimize to make sure that we've got more firepower to spend in the international business.
When we spoke last specifically about Tata Coffee, you said, look, it's work in progress. The board has not taken any decision on how to really, whether we should keep Tata Coffee listed or should we merge that with Tata Consumer. What is the status on that? Is it still a work in progress? Have you conclusively decided whether Tata Coffee will remain listed or will eventually be merged?
Nikunj, my answer remains the same, work in progress.
Okay, you're sitting on a cash of about 2,700 crore. If your ambition is to take your return ratios higher, with such kind of a strong cash on your balance sheet, how would you be able to achieve your targets of return ratios? Because cash on balance sheet will be a drag. So either the cash has to be given back or you will have to acquire something.
No, Nikunj, you're absolutely right. If the intention of generating better cash, and like I said, this quarter, for example, we've improved working capital by 16 days versus last year, from 57 to 41. Or every other lever in the balance sheet, in the cash cycle is being looked at. Free cash flow to EBITDA, I said last year was 65% for the quarter. This year is 82. So we are focused on generating cash. And the reason for generating that cash is not to sit with the cash. Last year, we did increase a bit of dividend. But going forward, I would say we are looking at aggressive growth, both organic as well as inorganic. The only thing, inorganic growth comes with a rider, as I've mentioned earlier. It has to pass muster both on the strategic framework as well as the financial filters. Only then we will move in. Nikunj, at any point of time, we are always evaluating 4 to 5 opportunities. The only problem is what we like is not available or doesn't want to play, and what is there to play, we don't like the metrics. So, but this is work in process. Acquisitions, M&A is never, you just don't decide that I'm going to do it every 3 months, I'm going to do so many numbers. You've got to get the right fit, and we are on the lookout.
But going back to that whole point on margins, I'm going back to it again because your peers are telling us a very different picture. You're of the view that the margin pressures are not that acute. Am I right?
I wouldn't say, you're absolutely right about the beverage business. I think margins are going to improve. On the foods business, we do see pressure, and we are working through trying to figure out ways to mitigate that pressure.
If you look across your portfolio, how much of your business you would say currently is at a transformational stage, and how much of your portfolio will only benefit because of the cyclicality?
I would say, Nikunj, broadly, the consumer products businesses which are there, which are added into my top line, mostly packaged beverages, foods, etc., I think are in a steady state, this thing, and we've got to continue to grow from here, especially the foods portfolio. The ones which will get the advantage of COVID being behind us and business as usual coming back very quickly would be the two out-of-home businesses that we have, and both in India, the Starbucks joint venture as well as the Nourishco business. Now, Starbucks, we are already seeing the uptick. So September, the month of September this year versus September of 2019, same-store sales was about 94%. So, I mean, business is coming back to normalcy. Nourishco, like I said, we've got, yes, there is the out-of-home coming back, but we also got geographic and portfolio opportunities. Year to date, up by 107%. I think these are the two businesses that we will really take off with the COVID being behind us.
Now, you've given a forward guidance in terms of where you want your return ratios to go. But given that this entire change in terms of raw material pressures, how cost, how cost escalations have happened across all commodities, will your path to reaching double-digit return ratios, will they get challenged?
I would say we are slightly behind on the return ratio front, but Nikunj, the essential piece is make sure that we get growth into the business. And like I said, now we've delivered 6 quarters of growth. So that is the one primary factor. Second factor is efficient deployment of the cash that we have to make sure we are creating more opportunities. That is work in process. Overall, we did have some ups and downs. Like I said, last year, the tea business, ups and downs. Right now, we're seeing a bit of pressure on the food business. But overall, I would say slightly behind, not significantly behind on improving the return ratios. Over a period of time, we are extremely aware that the return on capital employed or return on equity for Tata Consumer lags its peers. And we are aiming to keep it on a upward cycle to make sure we're catching up.
So how do you intend to create big brands, like your peers have? You have brands which are there in the tea category, but for you to get real growth back, you'll have to create your own brands. What is the strategy in place to create that?
So 2-3 things, Nikunj. For the portfolio that we have today, I think we've got the brands that we need. Number one. Number two, in some of the businesses, like in packaged beverages, I think our brand architecture is a little bit scattered. So there is work in process to look at that and streamline it. That's one piece. I think the second important piece is making sure that the distribution engine works to get availability then, but along with that, provide air cover. I think that is where we've been behind the rest of the industry. If you compare the A&P percentage of every other company, most people are in the high single digits, low double digits on total advertising and sales promotion expenses. We are slightly behind and we are taking conscious efforts to ramp it up. So if you look at my overall A&P spend, we are up by 50% versus last year. India business specifically is up by 75% this year. So we have to build firepower for the brands, build stronger brands, and then you will create that strength in the market, either to expand the brand or command pricing power.
The Tatas are also looking at creating a very large digital and a distribution platform. They've acquired Big Basket. They've acquired businesses which in the pharmacy space. How will this change life for Tata Consumer? Because distribution is a very large cost for FMCG players.
So Nikunj, effectively, whatever initiatives you're talking about are happening under Tata Sons and Tata Digital and the whole umbrella that they're creating there of the digital businesses. What works for us is because it's part of the same group, it helps us to work closely to figure out synergies in procurement, synergies in logistics, synergies in addressing consumers. So we will work very, very closely with these companies to make sure that we are creating win-win situations for both of us.
Sure. Lastly, wanted to understand if life has become normal for Tata Consumer employees, you coming back to office, and is everything now back to normal?
So Nikunj, our offices are open, and offices have been open for some time, and we've been constantly raising the percentage of employees whom we are allowing into the office. Albeit, I mean that the actual number is lower than what the ceiling that we put in. I am in office about 3, sometimes 4 days a week. We've started traveling. In fact, next week I'm in the Bangalore office. So yeah, from that perspective, I think life is coming back. But we are going at a, I would say, very measured pace, because we want to make sure that while we open up and we get in employees back to office and start traveling, we are making sure that we are not putting anyone at risk. Employee safety and employee comfort, most importantly, is right up front and center. Right now, we are into a hybrid model, and we will take, I would say, measured steps to get back to a fully normal situation. Now, what that fully normal will be, I think, has to evolve.
Sunil, great to have you on the show. Thanks as always for taking the time out and speaking with us that candidly.